Welcome to our regular currency chat. Every day we'll go in depth on the forex markets with top analysts and traders and our very own Trish Lui. Now, if you have any forex trading questions, get in touch. You know the email address, tradeWithHans@bloomberg.net, or message to trade on the Bloomberg terminal. Trish, as always, is with me. Lots and lots of your emails. But first, how's the week been for currencies?
Well, basically, the theme was a reality check, and risk appetite was being scaled back. You know, market decided that, you know...
Correction long overdue.
Yes, a correction long overdue. Market, it wasn't dramatic, but market decided to take stock of how much, the pace of the global economic recovery. I mean, we had Obama warning that the jobless, you know, it's a long road to recovery, jobless rate could hit 10%. We have China saying that economic recovery is still at a very critical and fragile stage, and then UK also warned that, you know, it's going to take a long time to recover, especially the banking sector. We also had ECB coming out to warn about the more banking losses over there as well. So yeah, it was very much of a reality check. Asian currencies all down across the board this week, led by Indonesia's rupiah, which was down about 3% Market, it was very clear
but
that
still
was
one of the best performers.
Still the best performer on the year. So like I say, you know, it wasn't a dramatic move, but nonetheless a long overdue reality check. There were stock outflows all across the region, so that's why the stocks market came off quite a bit. Aussie and Kiwi also weaker, especially against the high yielders. You know, those you play against the yen, that they came off first time since May. Also pretty healthy as far as traders are concerned. It was long overdue. There were concerns that, in fact, the part of the reason the Aussie and the Kiwi came off was risk of intervention. Central banks just felt that it's just gone a little too far ahead of itself.
Of course, BRIC nations in focus this week, given the meeting, and there, we have a question from a viewer. Sia writes in to talk about the BRIC countries. They say, you know, she says, I'm assuming it's a she, BRIC countries shake hands on the table but kick each other under it. The relationship could turn on a dime, especially when they were talking about a dollar alternative. Everyone is buying up U.S. treasuries since they could afford not to. They all have huge dollar reserves to protect and worry about. What do you think?
Well, he is right that they all have huge dollar reserves, and that was why they never mentioned anything about the IMF bonds after that. They do realize they could be shooting themselves in the foot if they talk down the value of the treasuries too much, which was what they had been doing in the run-up to the BRIC meeting. But as far as the strategies are concerned, the ones I'm speaking to, they say that all the rhetorics was simply to actually gain more as part of the posturing to gain more recognition within the IMF, or voting rights rather. They did talk, Russia and China did come up with an alternative. They want to use each other's currencies to settle bilateral trade and all that.
But having said that,
there was very few details here.
And having said that, people we talk to say that that's a long time. I mean, it is going to be a while before that actually can happen.
Exactly. Even the actual contracts, I mean, it was just a very grand announcement. There was no details about how the whole settlement can come about. And we have to remember, both the countries, their currencies are not actually freely convertible, especially for China. So it'll be a real test, like this viewer said, you know, whether China actually accepts the ruble payment and keeps it in its reserve. So that would be a real test of whether they were really seeking an alternative to the current to the dollar.
Okay, another question: the dollar-yen cross. What does it imply when it comes to risk aversion, and what does it mean for U.S. equities? This comes from DJI, I believe.
Okay, all right. Well, basically, the yen has always been seen as a funding currency. Of course, the dollar now is a funding currency, but the yen still retains this notion of being a funding currency. And Japanese investors, whenever global risk appetite actually improves, the yen tends to weaken simply because Japanese investors invest abroad. And basically, that's when, you know, as far as traders are concerned, when dollar yen rises, it means risk appetite is actually coming back. And yes, as the same goes for Aussie and Kiwi, the yen crosses. Whenever these crosses strengthen against the yen, it means that the risk appetite is back. But as we can see this week, all the crosses came off simply because global risk appetite actually took a bit of a reality check.
Okay, before we let you go, the theme ahead for next week.
For next week, it's going to be FOMC meeting. You know, traders will be looking to see what kind of signals the Fed wants to send, especially rate hikes. The market will still have this niggling thought about a possibility of a 25 basis point rate hike at year end. So we'll have to see whether the Fed, you know, stamps that out. They'll be looking at the U.S. Treasuries are very important. There's a record amount of Treasuries, $104 billion to be issued next week, which could actually send the yields soaring. And looking at LIBOR, there'll be a reconfiguration of how LIBOR was setting. More people will be coming in to set the rates, so there's a chance LIBOR rates could go up. So all this could actually influence the dollar.
Trish, rest well. It's going to be a busy week next week. Thank you so much for that.